Hello everyone, I hope you are well. I am glad that you are now in this lesson and following the work after the last lesson we had. So, in this lesson we are talking about accumulation. The last lesson was called deep accumulation, where we did a little more complex details of the basics of accumulation. However, in this lesson, we work a little more in detail and explain all the labels we talked about earlier. So, we worked on the last lesson. Accumulation, as well as the beginning of all their marks, which are initially called preliminary support, followed by selling climax, followed by secondary test, which is actually the main rotation point that we follow, so that in the end we can even know that accumulation is forming and secondary test in phase B. So, these are the marks that are actually the basis of accumulation. And all this for now falls into a smaller picture that we can detail in many different and we can say basic or complex ways. For now, we will work on more basic details where we will describe the validity of accumulation, in which situations it cannot be valid. What we said in the past lessons, I don't want to repeat again so that we can progress faster and better and with better quality. We did yes. Order blocks on a larger time frame do not have the same dimensional representation as when we look at a smaller time frame. So, when we enter a smaller time frame, we will most likely see the algorithm in that smaller structural part. If the order block looks like two candlesticks on a larger time frame, maybe on a much smaller time frame, the same order block will have a much more extensive structure and contain many different order blocks that can indicate some kind of analysis, which we need in order to be able to profit in the end. So we worked on the last lesson that after the secondary test, when it is formed, actually when it is rejected from the previous selling climax, if the previous higher level is transferred, then a sign of strength arises. So then a sign of strength arises that can only transfer the previous higher liquidity, but it must never transfer the first initial liquidity that started this structural part to form in the form of sales. So when we look at the secondary test, which in this case occurs in the uptrend, we must not see that after the secondary test, an uptrend occurs that transfers the previous initial liquidity, and only after that, the secondary test in phase B occurs again. So, that must not happen. And what characterizes the narrow picture? The narrower picture is characterized by the market structure. We see in this case that there is a market structure. It is characterized by the transfer of the previous higher level. It is characterized by the fractal of the first order block, which is in this case here, and the order block 2, which forms the analysis based on which we need to trade in the end. Wyckoff, that's from number 4. So there must be a Wyckoff, there must be all the labels we see here, and also the Wyckoff fractal. Therefore, all these order blocks must be of similar volume in order to be able to trade in the end. It features a fully valid short picture, but when we trade the short picture, then the maximum risk we can trade is 0.5%. So 0.5% makes the risk of narrower picture. And that is the only way we can focus, so that in the end the trade can remain valid, and actually so that in the long term such a trade would make sense. You have to practice this on different demonologists. You can practice on TradingView and take notes there. Check on backtesting whether the accumulation looks the same way. What are the further rules of accumulation? We must never trade the short picture if our risk reward is more than 2% of the risk. So, if, for example, this selling climax reaches very close to the previous lower liquidity than the previous order block, it means that we can only trade when the secondary test in phase B conveys that previous liquidity of the selling climax. In this case, the risk reward would be 2.9%. Because our stop loss is always at the lowest level of the previous order block, and such profit is at the highest level of the same order block, while the direct entry to the trade is located in a place called the selling climax liquidity transfer in the secondary test in phase B. And that tells us that in this case, as you can see, the risk reward is 3.08%, which it is not permissible to trade in such a way, which tells us that in this situation, we would not be able to enter any trade, nor would we be able to trade this trade because the risk reward is 3.8%. This tells us that the algorithm is very close to the previous lower liquidity, and thus the most likely downtrend will occur and make this accumulation invalid, and thus lose the percentage value. Therefore, it is very difficult for beginners to follow this kind of system and focus on various features of accumulation, but it is an experience that must be programmed in your head so that in the end there can be a long-term result. When we look in this case, instead of the selling climax, we always trade on the transmission of that liquidity, which tells us that in this case, as you can see, the risk reward is 1.45%, and then such a trade can be traded. Let's look further. This is the next part of the accumulation that we also did in the last lesson, where the marks we have learned so far are located. Preliminary support, selling climax, secondary test, and secondary test in phase B. As you can see, accumulation is a constant manipulation of lower levels. So we see constant manipulation of lower levels so that eventually the liquidity is absorbed into the volume, and so that all the previous more liquidity that was never transferred before is finally transferred. We do this based on observing the narrower picture, that is, observing the market structure of the previous order block, whether it is valid. That tells us that this order block must contain a complete order, while after it we must see impulsiveness, because in this way we know that this order block is valid by seeing that there is a complete order followed by strong impulsiveness. That strong impulsiveness is actually a presentation of previous investment, and that strong impulsiveness is called an incomplete order, which tells us that a complete order completes an incomplete order, and thus we can know that this accumulation that is here is in fact a complete order, and it is right in the range. In incomplete orders, which tells us that incomplete orders are being filled. Complete order, that same complete order must have an algorithm UCOF fully valid, so it must contain the algorithm of the complete order of quality analysis of all equal fractals, so that in the end we can understand it as completely valid and trade based on that. How is this picture different from the previous one we saw 2 minutes ago? Because here there is no transmission of the previous higher level after the secondary test, but there is a rejection from the previous highest level, and only then a downtrend occurs that forms an order block called secondary test in phase B. What does it mean? Whenever the previous higher liquidity is not transmitted after the secondary test, which is otherwise a rejection of the previous volume, therefore the secondary test never wants to transmit the selling climax, but must reject it and continue late buying, depending on whether it will form an automatic reaction or a sign of strength. Also, what is very important is that, yes, automatic reaction must never reach a level of below 80% of previous sales, or we can say 20% if we count this sale. So when we look at the downtrend that is emerging from the beginning of the form of the secondary test to the lowest level of the secondary test, we will see exactly where the half is located. We can use Fibonacci to best mark that, which tells us to then calculate the Fibonacci from half to the highest level, and that tells us that this is in fact, if we count from the beginning of the sale to the end of the sale, if it starts with 0 and here it ends with 100%, this tells us that then from that previous sale, the automatic reaction must reach at least 75% of the previous sale, so it must be up to this part reached. Not everything should be below, because in that way, then this accumulation will not be valid, and this tells us that the fractal of this secondary test is invalid and cannot be traded. So when we look at this purchase now, it clearly tells us that this downtrend that arises later, which conveys the liquidity of the selling climax, means that we can trade there. The same rules apply to this picture, so there must never be a risk reward greater than 2%. When we look at this case, the risk reward is 2.06%. Now we can write down one rule. If the risk reward is 2.06% or 2.03% or 2.07% up to 2.1% maximum, then we can trade again. So if our stop loss is at the lowest level of the previous order block, while our direct entry is on the transfer of the selling climax, then in this case we could trade because the risk reward is very close to the risk reward that we can trade. When we look at the smaller picture, the whole picture that we are looking at now, we clearly see that there is a preliminary order block, that there is impulsivity, which means that this order block is valid because there is an incomplete order after this complete one that happens here. And in that case, the complete order is completed with an incomplete order, which tells us that in this case, we see clearly that there is an uncles. Incomplete is filled with complete. So if we see that there is a complete order that does not look like accumulation to us, but simply looks like some kind of classic consolidation that cannot be clearly analyzed, it tells us that something is wrong there. What's wrong? Which item narrower images? So if the narrower image is divided into order, fractal, Uvachkov, and fractal structure. That's Uvaikov's fractal as the last one. That then tells us that there is a structure here because it is an uptrend. There is a previous order block. There is impulsivity that transmits that previous order block. But there is no Uvaikov if we see a complete order in this way, and then we would not be there, could trade. When we look later on the trend that arises here, it is impulsive. Why? Because this complete clear validity of the accumulation. Look at this picture now. Now that I enlarge this image, and when you look at what this looks like, it is very clear to you. So, that is exactly the analysis that we have done so far. Now we're going to take away the annotate pen to show you this. So, there is a previous order block that contains a complete order. We see that based on the order blocks and based on the absence of any incomplete orders during this part here. However, when we look at the later impulsiveness that arises, that impulsiveness is precisely the reason for the prior storage of the volume that is on this part here. The transmission of the previous order block makes this order block fractally valid with the other, because we see that this order block and the next order block that is formed are similar in scope, that is in this part here. This then tells us that there is a market structure here that indicates an uptrend. It says that there is the previous order block, actually this order block, which is valid because we see it based on a complete order and a later incomplete one, which is impulsive. We see that there is a fractal dimension. Let's move on. The fourth and fifth items. It exists in Vico, which contains preliminary support tags. In this case, the preliminary support is the distribution. Later, the selling climax that forms the lowest level. A secondary test that is rejected from the previous liquidity of the selling climax means it does not transmit the selling climax, but is rejected. And after that, there is an uptrend that does not transfer this previous higher liquidity and reaches the point that it is on the uptrend if we count this sale from the beginning of the sale to the end of the sale, and if we count it on the uptrend from the purchase to this level here. This then tells us that there is an automatic reaction that reaches and bounces off the previous higher level, later exactly in the part called secondary test in phase B. There is our direct stake in the trade entry, where the risk is 0.5%, and then liquidity is absorbed into the volume. We see this on the basis of this slowing down of the price, where later an impulsive uptrend arises, which later transfers more and more liquidity and reaches our take profit, which means that here we are in profit around somewhere 0.80% because the risk was 0.5%. And our take profit is here somewhere around 1.80, which tells us that here is roughly somewhere around 0.6070 or 0.75% profit. It is the explanation of accumulation from this point of view that I want to share with you. So, all this must be practiced, followed in detail. I hope this lesson made a big impression on you. Of course, there will be many more lessons that I will work with you that you can follow and based on them to elaborate in detail all the details that we have done so far. I wish you all the best and see you in the next lesson. To everyone, greetings.